Hello, agents. Hello, everyone. Well, welcome to 2024. Interest rates are balancing out about 4% Treasury today. That was down to 380. So we're kind of balancing out. I think they pre-priced in some of these drops. So 4% today, 4.25 is where we're really happy. Down, look, see it drop right back down to 398. So we're hovering right around there. It'd be great to see that thing jump above 4.25. But today, what we're going to talk about is immediate annuities and check out how the pricing has increased for the same amount of income. So $40,000 is more expensive today than it was a month ago. So let's take a look at these premium numbers and see where we're at. This is for $40,000 annually, and this is how much it costs to fund this for a male and a female for their lives and certain options we'll get into with this right away. Hold on one sec. So yeah, we're all ready to go. We'll take a look at this. For page one, let's look. All right, so we're actually looking at a monthly income of $33, $33, and 34 cents. This is life with installment refund annuities. So life and installment refund. So here's the male, $40,000, age 55 to 70. As you can see, the 55-year-old costs $622,000 to fund this, $40,000 annually. The 75-year-old you see there is $429. Here are the female numbers. And this is how this works out, right? So you're going to give the insurance company the premium. The income is going to begin 1 month after they receive that premium. These numbers on the page here are all inclusive. They're after all internal fees, costs, commissions, everything like that, state taxes. Well, these don't include the state taxes, but if you had state taxes, it would be included in the numbers you see. These rates are as of yesterday. I ran these quotes yesterday. This actual quote would be good for 14 days if you ran it yesterday, but they're subject to change at any time. So if you run it today, you might get a different number than yesterday. And they could get better as rates go up, and they could go down as rates go down, as you're going to see here. This company's a 94 Comdex ranking. It's a super high rated company. I just run this one company. Now, other companies might do a little better. Many companies will do worse, but this just gives us a nice little benchmark at the top of the range of the cost for these. So the premium needed on these will also be higher, of course, in premium tax states like listed below, like California and Colorado and those states, Nevada. So anyway, that's the installment refund period. This is the installment refund period. How long does it last? So if you're age 55 and you put 622 in, it's 15.55 years that payment's guaranteed. So whatever's longer, like 15.55 years or that person's life, it's going to pay for the longer of the two. So that's how that breaks down. There's the female numbers. And if you want to know how it works, it's the income is for longer of life or the refund period. And to get these years I did to solve that refund period, just simply take the premium and divide it by $3,333.34. And it'll break down how long it takes to get the money back. And that's your break even. That's when your premiums return to you and anything after that. So let's say the client, 55-year-old, died in the 10th year, 5 years would go to the heirs. But if he's alive in 30 years, it'll still pay to him, right? Pretty simple. So showing my work, this is the illustration. Of course, non-qualified money using 100% of cost basis will have an exclusion ratio. So of this payment, as you see here, the non-taxable portion, the taxable portion, assuming this whole 537 was non-qualified money, you'd get a tax break. So this is really something, tax exclusion on the income. So this is something most people don't know about immediate annuities. So if the person lives to 95, it tells you what the return is, of course. There you go. The refund is the minimum return. So that's your minimum return is your deposit, right? It equals that. The payout percentage is 7.4%. So that's how much of your money you're taking every year. It's not an interest rate or anything. This is the last time I did this quote was in August, as you can see here in August. So this is the August. This is the January I just did, right? So 7.4, it cost 537 yesterday to do this. And now it was 528. So it went from 528 to 537. So almost $9,000 more for this exact same person to get the exact same income a few months later. And let's take it a step further. Let's look at the best rates we saw, recent highs, which were in November. So this is an actual real quote that we ran. The person did not buy in November. Now they're still looking. So you look, that same amount of money, that $80,538 in November, it was paying $588 a month. here we are in January, it's $554 a month. So basically by waiting, this person lost $34 a month for the rest of their life, right? Changing from an 8.3 payout, from an 8.8 to an 8.3. So this is just like one of those things I say, like, you know, the cost of delay is you got to add in how much money you're going to get for waiting, but how much you're losing by missing all those payments. So in this particular case, it would have been much better for the person to buy, obviously, in November because rates were higher and you would have got that extra payment and all that time. So all that good stuff. So anyway, what I always say is when you're ready to buy an annuity or something, buy the best rate at the time you're ready. Don't try to wait and time things out, or, you know, be very good on your timing, because I did receive some rate changes on Friday before the holiday weekend at like 3 o'clock or 1 o'clock our time. It was like 3 o'clock where the company was, and it needed to be in that day to get the rate. So how could you even talk to anyone? Like, it's the weekend, everyone was closed early. Monday's a holiday. So that was like an instant rate change. So for anyone that was on the hook there, that rate changed instantly. Yeah, so that was a surprise to us, and that was a big drop, you know, big drops in these immediate annuities and other stuff. So anyway, yeah, that's just a comparison of November, which was our super highest rates in like 20 years compared to today. And hopefully, you know, this is basing it on the 380. Today it's at 4. So we'll see what rates do going forward. Yeah, and as you can see, the better return has a lower exclusion ratio because more of the money coming back is interest. So the higher the exclusion, the lower the interest, right, being paid. So the better the deal is a lower exclusion ratio, because that means more interest is being paid than principal. So as you can see, 15.2, 16.2. So yeah, this person has a higher exclusion ratio, but lower income. This one has a lower exclusion, but higher income. So yeah, that's how that works. So, and again, the annual payout percentage is a ratio of total an annual annuity income premium, right, to the premium, like how much of your money you're taking. It's not a percentage. It's not an interest rate. It's not a rate of return. There's no fixed annuities out there paying 8% rate of return. If you see anything like that, there's a game being played. It's not a guaranteed interest rate. It's a roll up. It's something. It's a past historical return. It's a 1-year thing. There's no one paying 8%. Like 6 is the best I've seen out there. 6. So anything higher than 6 on a guaranteed basis, red flag should go up. Okay, in current environment. Okay, so yeah, that's the end of my presentation. Welcome to 2024. I hope you all had a good new year, and we'll just keep watching that treasury. Hopefully rates will stabilize and not plummet too much more. We did see some big drops here at the end of at the end of December. So anyway, hope all is going well. Thanks for watching, and we will talk to you very soon. Bye-bye.